Good morning, everyone. Today, we're starting with one of the most exciting topics in accountancy basic accounting terms. Are you ready to explore the language of business?
Yes,
Yes,
sir.
sir.
Okay, let's start with the basics. Who can tell me what is accounting?
Sir, accounting is keeping track of money, like how much you earn and spend.
Sir, it's about recording and organizing all the financial information for a business.
Sir, I think accounting helps us understand if we're making a profit or losing money.
Exactly, students. Accounting is the process of identifying, recording, summarizing, and communicating financial transactions. Think of it as a way to organize and understand how money flows in and out of a business. See, this is the process of accounting: identify, record, summarize, communicate. Now, who can tell me why this process is important?
Sir, I think this process is important to know if the business is making a profit or a loss.
Great point, Bushra. Profits and losses are just one aspect. Accounting also helps businesses manage their finances, follow rules, make smart decisions, and plan for the future. Okay, students, we've discussed what accounting is and why the process is important. Now, let's move on. Accounting isn't one size fits all, it's divided into different types based on its purpose. Can anyone name one?
Sir, there are two types of accounting.
One is financial accounting.
And sir, the other one is management accounting.
Excellent, students. Let's discuss each one by one. Financial accounting deals with preparing financial statements like balance sheets and income statements. Businesses use these to show their performance to investors and stakeholders.
Papa, what are you working on?
I'm looking at the balance sheet, income statement for this month. It shows how much we earned from sales and how much we spent on expenses. It also tells us the profit we made after covering all costs.
What this report called in accounting? And what is this for?
This report is called financial accounting. It helps me track our profit and loss. I can also show these reports to the bank if we ever need a loan to expand the store or any investor.
Another type is management accounting. Any guesses on what it's about?
Sir, does it help managers make decisions?
Exactly. Management accounting is all about helping managers. It gives them the information they need to plan, make decisions, and manage the business better.
Papa, why do we have so much rice and cooking oil on the shelves?
That's because there are best-selling items. I keep track of what sells the most using management accounting. It helps me decide what to stock more of and what to reduce.
How do you know these are the best-selling items?
Management accounting helps me make these decisions. We check which products are selling the most and then decide to stock more of them. It's all about understanding what customers want and managing the store better.
There's also cost accounting. Can anyone guess what it focuses on?
Sir, is it about figuring out costs?
Exactly, Nishant. Cost accounting is about finding out how much it costs to make products or provide services. This helps businesses decide the right price to charge.
Papa, how do you decide the price for each item?
That's where cost accounting comes in. For example, let's take a pack of rice. It costs us $50, including delivery and storage. So we price it at $65 to make a profit.
Oh, so you calculate the cost first and then set the price? With cost accounting.
Exactly. This way, we make sure we're earning enough without overcharging our customers.
See how Mr. Rajkumar uses financial accounting to track profits and expenses, management accounting to decide what to stock and sell, cost accounting to set the right prices. These types of accounting help him run his grocery store successfully. Now let's discuss some key accounting terms. First, what do you think assets are?
Sir, there are things a business owns, like money or buildings.
Excellent, Nishat. Assets are the resources owned by a business that have value. These can be things that help the business run or can be sold to make money. Examples include cash, equipment, inventory, vehicles, or property.
So, sir, assets equals resources owned by a business with value.
Exactly. Assets equals resources owned by a business with value. Okay, student, watch carefully. We will learn asset with Mr. Rajkumar example.
Papa, what are you working on?
I'm looking at our store's assets, Nishant. Do you know what that means?
Not really. What are assets?
Assets are things the store owns that are valuable and help us run the business. For example, the money in our cash is an asset because we use it to buy more stock or pay bills.
These grocery items like rice and snacks are assets too. We sell them to make money. Okay, Papa, I got it. Anything valuable to the business that helps it run smoothly is an asset.
Okay, student, next, let's talk about liabilities. Any thoughts?
So they're what the business owes to others, like loans.
Exactly. Liabilities are what a business owes to others. It's obligations or debts a business needs to repay. It's like promises to pay back money, such as loans or unpaid bills. So, in simple words, liabilities equals debts or obligations that a business needs to pay back. Okay, students, can anyone give me an example of a liability?
Sir, a loan taken from a bank is a liability.
Unpaid bills like electricity or rent are liabilities too.
Excellent. Both are correct. Liabilities are anything the business owes, like loans, bills, or payments to suppliers.
Oh, Papa, you got such a big electricity bill this month. Don't pay it. We might run out of money.
Nishant Beta, this electricity bill is a liability. We have to pay it.
What is a liability, Papa? And why do we have to pay it?
Beta, a liability is something we owe to others. It's like a promise to pay back money. For example, this electricity bill is a liability because the electricity company provided us power, and now we owe them payment.
So, liabilities are like our debts, and we must pay them back to keep everything running.
Yes, Beta, liabilities are debts we owe, like bills or loans, and we have to clear them to keep the store running smoothly. That's why it's important to pay bills, like electricity or rent for this shop on time.
Okay, students, we've learned about assets and liabilities. Now let's talk about equity. Who can give it a try?
Sir, I think equity, the money left after paying all the debts.
Great try, Bushra! Yes, equity is the value left for the owners of the business after all debts, liabilities are paid. It's like the owner's share of the business.
So, sir, equity represents the owner's remaining interest in the business after subtracting liabilities from assets.
Yes, Ansh, that's correct. Equity equals assets minus liabilities. It shows what's left for the owner after all debts are paid.
Papa, you said we have assets and liabilities, but how do we know what really belongs to us?
Good question, Beta. Let's think of it this way. If the shop owns 1,50,000 rupees worth of assets and we owe 50,000 rupees, then 1 lakh rupees is our equity. It's our share in the business.
That's easy to understand. It's like solving a simple math problem, subtracting our liabilities from our assets. Equity equals assets minus liabilities.
Student here, tricky question for you. Now, if Mr. Rajkumar's store makes a profit of 30,000 rupees this month, can anyone tell me what will happen to his equity?
Sir, his equity will increase by 30,000 rupees because profit adds to equity.
That's absolutely correct. So, if we add profit to equity, we get the total value of the business, which includes both assets and liabilities. In simple terms, equity plus profit equals assets minus liabilities. Alright, students, let's move on to the next topic. Why do you think accounting is called the language of business?
Because it helps communicate financial information, sir.
Exactly, Ansh. Accounting is like a language that helps businesses tell others how they are doing financially. It helps businesses share important information and make good decisions. Without it, running a business would be like driving a car without a map. Okay, class, let's move on to the next part. I'm writing capital receipts and revenue receipts on the board. Can anyone guess what these mean? Alright, students, let's start by understanding what a receipt is. Once we know that, we'll move on to the two types, capital receipts, and revenue receipts. A receipt simply means money that comes into the business. It could be from selling goods, getting a loan, or even investments. Does that make sense?
Yes, sir. So whenever the business gets money, that's called a receipt, right?
Exactly, Ansh. You've got it. Now, let's talk about the two types of receipts: capital receipts and revenue receipts. Can anyone guess what the difference between the two might be?
I think revenue receipts are from regular business activities like selling goods or earning interest.
And capital receipts must be from non regular activities like selling an asset or taking a loan, right?
Great, student! Revenue receipts are the money a business gets regularly, like from sales, interest, rent, or commission. These happen again and again. Capital receipts, on the other hand, are not regular. They happen only once in a while, like when a business sells property or takes a loan.
Okay, sir. So, revenue receipts are like the everyday money coming into the business, and capital receipts are more like one time events.
Exactly. Student, capital receipts come under the balance sheet, and revenue receipts come under the profit and loss account. All right, class, let's move on to an important concept: expenditures. Just like receipts, expenditures are also divided into two types: capital expenditure and revenue expenditure.
Sir, expenditure is it money we spend?
Exactly. Expenditure means money going out of your pocket. Let's start with revenue expenditure. Anyone want to share?
Revenue expenditure is money going out of the business regularly.
Exactly. It's money going out of the business regularly, something you do every month or so. Can you think of examples like maybe paying rent or wages?
Yes, like paying for electricity bills or salaries.
Perfect. Those are exactly the types of expenses that fall under revenue expenditure. Let's talk about capital expenditure. Can anyone guess what it might mean?
Is it money spent on buying big things for the business and it happens once in a while?
Exactly, Nishant. Capital expenditure is usually for buying assets that will benefit the business long term. These are one-time purchases, like land, buildings, or machinery.
So, capital expenditure is like making an investment for the future. And revenue expenditure is just what you need to keep the business running.
Perfect, Bushra. That's a great way to put it. Just like capital receipts go under the balance sheet, capital expenditure also goes there. It appears on the assets side. On the other hand, revenue receipts and revenue expenditure go under the profit and loss account. All right, students, now it's time for a few questions to check if you've understood the concept clearly. When the business pays rent, would that be considered a capital expenditure or revenue expenditure?
So, revenue expenditure. It is a regular, ongoing cost, so it will be recorded in the profit and loss account.
Okay, if Mr. Rajkumar bought a truck and a shop, what was that? Is it capital expenditure or revenue expenditure?
Sir, it will be capital expenditure spending on assets like trucks or shops that will be used for long-term purposes.
Now, there's one more type of expenditure called deferred revenue expenditure. This is something that you pay regularly, but the benefit lasts for a long time. Can anyone guess an example of this?
Is it like advertising? You pay for ads, but the benefit lasts for months, sometimes even years?
Exactly, Nishant. Advertisement is a perfect example of deferred revenue expenditure. You pay for it regularly, but the benefits, like brand recognition, last a long time. Let's take an example. Imagine Superstar got paid 5 crore rupees to do an ad for hair oil. This ad will help the company sell more hair oil for 5 years. Now, tell me, what happens if the company says they spent all 5 crore rupees in just 1 year?
It will look like they lost a lot of money that year because 5 crore rupees is a huge amount.
Exactly. If they charge the full 5 crore rupees in the profit and loss P&L account in 1 year, it will show a big loss. But is it fair to show such a big cost in just 1 year, even though the ad helps for 5 years?
So, revenue expenditure. It is a regular, ongoing cost, so it will be recorded in the profit and loss account.
That's correct. What the company does is treat this cost as a capital nature expenditure. They put it in the balance sheet under a special account called deferred revenue expenditure. Now let's talk about goods and stock. Goods refer to items that are bought or sold in your business, and stock refers to what you have on hand, whether it's goods you've purchased to sell or finished goods that are ready to sell.
So, sir, stock is like everything you have, whether it's raw material, work in progress, or finished products.
Exactly. Just like receipts and expenditures, stock is also divided into categories. Raw materials are the materials used to make a product. Work in progress refers to items that are still being made. Finished goods are products ready to sell, and stock in trade is what you buy to resell directly.
So it's like raw materials are the starting point, work in progress is the middle, and finished goods are the end product.
That's right. Now let's quickly go over debtors, bills receivable, and trade receivables.
Sir, a debtor is someone who owes you money, right?
Exactly. A debtor is someone you've sold goods to, but they haven't paid yet, and bills receivable are like formal promises to pay. If someone owes you money and gives you a signed note saying they'll pay in 2 months, that's a bill receivable.
So, sir, debtors can owe you money without a set date, but bills receivable have a specific date to pay.
Yes, exactly. And all of this comes under trade receivables. People who owe you money from your business transactions.
So, trade receivables include both debtors and bills receivable.
Exactly, Ansh. Great job, everyone. You all seem to be understanding these basic accounting terms very well. Now let's dive into something more interesting. Let's discuss creditors and debtors.
Hello, Mr. Sharma. I need 100 packages of rice for my store. Can I pay you next month?
Sure, Mr. Rajkumar. You can keep the rice and you can pay me later. Since you owe me money for this delivery, I am your creditor.
Mr. Rajkumar, I need groceries for this month, but I don't have the money right now. Can I pay you later?
Sure, ma'am. You can pay me later. Since you owe me money for these groceries, you are my debtor.
So, when we buy goods on credit, the person we owe money to is called a creditor. And when we sell goods on credit, the person who owes us money is called a debtor. Is that right?
Exactly. And remember this, you have to pay money to creditors and you have to receive money from debtors. This is a very important concept to remember in accounting.
Got it. Creditors and debtors, it's all about who owes what.
Yes, you're right. Students, debtors are our asset. So they come on the asset side of the balance sheet, and creditors are our liability. So they come on the liability side of the balance sheet. Now, let's move on to something a bit different. What is a voucher? A voucher is simply a document, a proof of any transaction. We use vouchers to make general entries. I will teach you more about vouchers in Chapter 8, where we'll go into detail about source documents. For now, just know that a voucher is proof of a transaction.
So, vouchers are like receipts or documents that show a transaction has taken place.
Exactly. Now, moving on to discounts. Whenever you sell goods, sometimes your customer asks for a discount. Give me a discount. Reduce the price. That's what a discount is.
So, a discount is a reduction in the price of goods.
Yes, it's either an allowance or benefit offered by the seller of the goods.
So, I want vegetables, tomato, cucumber, and spinach.
Of course, ma'am. Here are all the vegetables. Please help yourself.
This is all I want to buy. How much for everything?
It will be $15, ma'am.
No, it's too much. I can give you $10, okay?
Okay, ma'am. How about $12? I cannot go lower than that.
Okay, here you go. So,
Discount is of two types, trade discount and cash discount.
Sir, what's the difference?
Student, trade discount is given on the MRP of goods and is given to all customers to boost sales. Cash discount is given only to those who pay in cash immediately.
So, trade discounts are for everyone and cash discounts are for those who pay cash right away.
Exactly. Okay, students, tell me, will the discount be shown in the profit and loss sheet or the balance sheet?
It will be in the profit and loss sheet, as it comes in the expenses side of the P&L account.
That's correct. Discounts are an expense for the business, so they are shown on the expenses side of the profit and loss account. Well done. There's also something called a rebate, which is similar to a discount but is generally in terms of amounts, not percentages.
So is rebate like a special offer then?
Exactly. A rebate is like a special discount you get after making a purchase. For example, if you buy 10 rice bags from Mr. Rajkumar's store, he might offer you 100 rupees back as a rebate. It's a way to save money. Okay, now let's quickly cover a few more terms. What's turnover? Anyone know about turnover?
Sir, turnover is just the total sales of a business. It's often used to measure the size of a business.
Exactly. Turnover is the total sales revenue of a business. Let me give you an example to make it clearer. Mr. Rajkumar's grocery store sells 50,000 rupees worth of goods in a month. That's his turnover for the month. Turnover equals total sales revenue. I hope this is clear to everyone. Alright, students, let's understand the difference between revenue and turnover in a simple way. Revenue is the total money a company receives, not just from selling products, but also from things like interest or other sources. It's like counting all the income the company gets. Turnover, on the other hand, is the money a company earns only from its main business activities, like selling goods or services. Now, can someone give me an example of turnover and revenue?
Sir, if Mr. Rajkumar sells goods worth 50,000 rupees from his shop, that 50,000 rupees is his turnover. But if he also receives 20,000 rupees as rent and earns 5,000 rupees in interest, then his total revenue will be 75,000 rupees.
Exactly. And finally, investment refers to money you put into any business or asset. When you buy shares or debentures, you're investing your money.
So, sir, investment is about putting your money into something, hoping to earn back more in the future?
Exactly. You can buy shares or give loans, debentures to a company, and they'll return your money with interest. Investments like fixed deposits, shares, and debentures are shown on the assets side of the balance sheet. Alright, class, we've covered a lot today. Make sure to watch this video again and understand these terms thoroughly. The stronger your basics, the better your understanding of accounting will be. Class dismissed. Don't forget to like the video, share your thoughts in the comments, and connect with me on Instagram. I'll see you soon with a new video. Take care and keep learning. Bye-bye. Thank you for watching. Don't forget to like, share, and subscribe for more updates. For more information or to purchase the full course, feel free to reach out to us.